Friday sees markets turn their attention to the US jobs market as we start the new month with a payrolls release on that first day of the month. Now, of course, the week is going to be dominated by corporate earnings with 5 of the Mag 7 names reporting, but there's some big questions being asked of the potential pathway for the Federal Reserve with yields moving towards the upside, US election around the corner, and a possibility of some weakness in the jobs market. It's all to play for as we look ahead to Friday's non-farm payrolls and overall jobs reports out of the US. So here is a look at the overall market from a relatively simplistic standpoint. So looking from a sort of long-term perspective, what we can see here is the unemployment rate, whilst it has seemingly bottomed out and we have been seeing it move towards the upside over the course of the last year, we have not seen it actually really escape that bottoming pattern and push sharply higher. That had previously called for a recession when we did see a rebound into the 4.3 measure, but the 4.3 level, we're now down to 4.1. So that has been allayed for the time being. If you look at the payrolls number, 254 last month. So very strong payrolls number. And that, by and large, pretty much just ruled out the opportunity to see a 50 basis point rate cut in November. And so that, to some extent, has provided the basis for strength for the US dollar, upside for US 10-year yields. But there's question marks around that. And that's because we're seeing expectations within the market signaling the possibility of a significantly weaker number this time around. So could we see that strength from last month undermined somewhat? Average hourly earnings continuing on that downward trajectory below the 4% threshold. But certainly, as long as we see that downward trajectory continue, then inflation isn't a massive concern. Here is the outlook according to Trading Economics. What we can see here is that the non-farm payrolls figure, according to this website, is at 180K. Now, it's worthwhile noting that we have wide disparities. If we look at the figure coming from Forex Factory, it's 108K. So very big difference between the two. And so, there is a good chance that we come in significantly below that. And I'll show you a reason for that in another slide. First and foremost, though, let's look through this. So expectations that we see lower payrolls, higher unemployment, so up to 4.2, average hourly earnings expected to stay steady at 4%, but a monthly figure of 0.3, that's fine. And then if you look at, say, the U6, so sort of total unemployment rate, that's expected to rise as well, up to 7.8%. So if we look in terms of the breakdown of the top ranked forecasters according to the London Stock Exchange Icon platform, what we can see here is that if you're talking about the possibility of 180K on that payrolls figure, all of the top forecasters come in below that. And we've got some banks in particular that have got forecasts that are really significantly below that. I mean, look, you're talking about the Morgan Stanley 75,000, Continuum Economics 75,000, Oxford Economics 75,000, Regions Bank 44,000. Out of the 10 that I'm showing you here, half of them are below the 100K mark. So there is definitely a possibility that we come in weak on the payrolls figure and it sort of evens out compared to last month. Also, we've got the possibility of an upside move in terms of unemployment. So all of it could really sort of go against what we saw last time around. That's what could be the theme this time around. What we've seen so far this week is the JOLTS data that has come out as of the time that I'm recording this video. And in terms of that JOLTS data, we have seen the move towards the downside continue. So 7.44 million, significantly lower than forecast, which is 7.98 million on the job openings figure. So a continuation of that downward trajectory, more underlying weakness, but we haven't necessarily seen that in unemployment. You can see that this relationship between the two seems to have somewhat broken down because we're seeing a wider gap between the likes of the job openings, the likes of the quits and discharges. versus the unemployment rate, which continues to remain flat. Of course, the unemployment rate on this is inverted. That's why it's elevated. But yeah, it's continuing to sort of trundle along the bottom. But like I said, markets expecting the possibility of a move towards the upside this time. In terms of wages, this is a breakdown the current state of play because essentially we have this relationship between average hourly earnings and the core CPI number, i.e., wages feed into business costs and then that gets passed on to the consumer. What we've seen at the moment is a move towards the upside of late. We have, though, got a downward trajectory. It's around the 4% mark. But certainly, if we see a move towards the downside, that'll be a welcome development. But as things stand, markets expecting 0.3 on the month-on-month figure and then a 4% metric for the year-on-year number. You can see here in terms of the annualized wage growth figure has moved towards the upside to a back above the sort of norm that we had sort of pre-pandemic. As you can see, I've shaded it here with a grey sort of horizontal band, so to speak. So the recent trajectory of wages is over and above what we would hope. So it's sort of moving away from the direction of travel that it has been on over prior months. In terms of market expectations, you can see that what had been factored in previously appears to have gone over the course of the last month. And that really highlights the change that we've seen since the last US jobs report, because there were expectations of at least one of these last two meetings of the year coming in with a 50 basis point cut. That has now been completely ruled out by markets. And there was also an outside possibility, but a pretty significant one here, 30% a month ago, was attributed to two 50 basis point cuts. So I thought personally, I was saying at the time, I thought that markets were getting a little bit carried away with themselves. At most, they'll get a 50 basis point cut, but I didn't necessarily see that necessarily happening. Either it looks like markets now just expecting 25 basis point cut at each of the final meetings. And then if you look beyond that, the year ahead, there's just expectations of a cut pretty much every other meeting. So certainly right now, markets have cooled their expectations significantly. And that has led to some extent towards strength for the likes of the US dollar. Now, if I bring up the chart for the dollar index, here we have it here. Let me just get rid of this. So this is the trajectory of the dollar index recently on the daily time frame. October has pretty much just been a straight line. We have the odd pullback, the odd down day, but by and large, very consistent uptrend here for the dollar index. Now, that comes off the back of the payrolls release that we saw coming out last time. If we look for the exact date of the last jobs report, let me just bring that up. So October the 4th. So October the 4th was here. Let me just get a vertical line. So October the 4th is there. So you can see that move essentially marked the breakout from this double bottom formation, and we've been moving onwards and upwards from there. So if the strength of last time's meeting provided the basis for upside, could we subsequently start to roll over? Well, let's look from a wider perspective. What we can see is that over the course of 2023 and into 2024, we have seen this market by and large range bound. Now, we haven't got into the top end of that range thus far, but we have still got levels that in the past have been respected. And you can see that here. So we've got that peak here from May 2023. We've got the peak here from February 2024, and we're back into that level at the moment. It doesn't necessarily mean that this is exactly where we're going to roll over, but it's certainly worth noting that if we start to break back below, say, your 103.9, then that would, on an intraday basis, signal the end of this near-term uptrend. And so as we look to be slowing down at the moment, there's a possibility that we could see this start to roll over somewhat. Notable that everyone's talking at the moment about the US Treasury yields. We've seen this big surge in terms of yields, and that comes into it as well, right? So we saw the pivot from the Federal Reserve. The pivot ordinarily you would think would lead to weakness. We saw that 50 basis point cut, and what's happened since then? we've seen a massive surge in terms of borrowing costs. Borrowing costs are a problem because we've got a huge amount of debt that needs to be serviced, and they don't want to do so at elevated prices. So how do you drive down the US 10-year? Well, one way of doing it is easing at a faster pace. At the moment that we saw that jobs report that came out strong, markets started to reprice away from 50 basis points at every meeting at the end of this year and a cut at every meeting. And all of a sudden, it's like, oh, well, maybe we'll get 25 basis point cuts this year. And next year, it's going to be a cut every other meeting. So it almost feels like markets just swing from one extreme to another. And so by and large, you're looking at the moment, in my mind, at something that could swing back in the opposite direction. In particular, if we see a weak jobs report, if we see a weak payrolls number, as we've seen, the top forecasts are all signaling that. Many of them, half of the top 10, are pointing towards a figure below the 100K mark. Markets are also expecting to see unemployment rate to move towards the upside. If we saw that, I wouldn't be surprised to see the 10-year start to roll over. I wouldn't be surprised to see the US dollar start to roll over again. And like I said, 104.93 is going to be the key support level to watch out for on that. The trend is always your friend, and the trend does still remain bullish over an intraday time frame. But certainly from a wider perspective, we've come into this resistance zone, and we're at the first part of it. And so certainly if we break down through support on an intraday basis, that could point towards possibility of weakness coming into play. But really it depends on whether we see a particularly weak jobs report. This is the S&P 500, and we can see that this market has just been moving onwards and upwards. Notably, if we were going to, let's see what I've got on here at the moment. I've got a breakdown in terms of the election. So notably, if I was to say bring up the dollar index, what we're seeing here at the moment is a positive correlation between the US dollar and US stocks. That isn't always the case. It's often not the case because we often see the US dollar as a haven. Also, we often see the US dollar strengthen at times where we see monetary tightening and weaken at times that we see monetary easing or an expectation of greater easing. And that is generally good for stocks. So by and large, you would expect to see inverse correlations. Weakness in terms of stocks leads to upside in terms of the US dollar. Weakness in terms of the US dollar leads to upside in terms of stocks. That's not what we're seeing at the moment. And I don't necessarily think that that's going to play out forever. I think soon enough, we would see that inverse correlation come back into play once again. As you can see here, weakness, strength, but recently both moving in the same direction, as we can see here, probably on the intraday chart will show it better. So there you go. Very nice upward trend for both of these. So which one's in the wrong? Well, look, we've got significant uncertainty ahead. And so, the impact of some of these corporate earnings will be key. If we start to see the US dollar rolling over, I would expect to see the S&P 500 rolling over. I would expect to see the dollar continue to move towards the upside. But there is a possibility that we see this US dollar starting to roll over if we see a weak jobs report. And then it comes into question as to whether markets want to celebrate the idea that we see potentially more rate cuts, or whether it grows fearful about the trajectory of the economy, whether good news is good news or good news is bad news when it comes to the equity markets. But one thing is clear, we've come into a key support level, this ascending trend line, really playing into the continuation of this bullish trend that's been playing out since that low here in August, and the bulls are back in charge. The hourly time frame shows you exactly that. We can see this stepped move up over the near term basis. So we've got these higher lows. We came close to this 5799 level, but then we've moved sharply away from that and we're pushing onwards and upwards. So the trend is your friend. It remains bullish as it does for the US dollar. I do think the dollar's at risk if we do see a weak jobs report, that we could see the 10-year yield roll over and the US dollar move with it. But then, there's question marks around the trajectory of US equity markets. Part of it's going to come down to corporate earnings, and part of it's going to come down to the perception of this election, because there is a view that the period post-election is going to see significant outperformance for equity markets in the US, in particular if it goes the right way. I mean, it depends on how you view it, but I think markets by and large think that a Trump victory is probably going to be better for markets because of the the respective tax policies. But nonetheless, that's going to be playing into it as well. So a little bit less clear cut. But between the two, both of them continue to move towards the upside, whether it's US stocks and the US dollar. And the question mark is, will we see that weak jobs report come into play to undermine the rebound, in particular for the US dollar and the 10-year yields that we have been seeing dominating over the course of the last month in the wake of that last US jobs report?